Good afternoon, everyone. It's honor to have Jay Pelosky here with us, once again. Without further ado, I'll kind of, tell you what we're going to talk about. We have co-written a great article, which is today, out on Brazil Journal, and talking about, rising rates in the U.S. Of course, this was the talk of the market. I mean, global markets in the morning. Brazil aside, but Brazil we're going to talk in the end. So I'd like to turn over to Jay so he can go over the main points in the article and why people should keep calm, move on, and not worry about rising rates in the U.S. That's actually a very good thing. So thanks again, and over to you, Jay.
Thanks, Roberto, and hello, everyone. And yes, it was great to co-write that with you, and it was so easy. We need to do it more often. Usually it's not that easy to co-write a piece. But I would say, Roberto, one thing I would mention is that, you and I have been talking about why higher rates would be a good thing for several weeks, even though it's just now in the last couple of days kind of become the topic du jour for many investors. So I would think that kind of suggests that we, at least in this issue, have been a little bit ahead of the curve. We actually even turned in that piece a week ago, and it got held up a little bit because of Carnival and the holiday in Brazil. But for me, I felt for a long time that higher rates are a good thing. And just think about what higher rates mean. It means that COVID is being brought under control. It means that confidence is returning. It means that economies are reopening. And it means that money is going to cost a little bit more. And granted, we're at a point where money is virtually as cheap as it's been in modern history. And so the idea that it's going to cost a little bit more, rates are going to go up, the price of money is going to go up. It should not be a big surprise or a big negative. And if you compare that to the opposite, let's say that we don't want higher rates, we want lower rates. Lower rates would come because COVID is not being brought under control, because confidence is being lost. Economies are in even tighter lockdown. We have a deflationary environment. And we have a situation where markets are selling off around the world. So that's clearly not an environment that I think anyone would want. We had that a year ago. And so now we're coming out on the other side, and rates are coming up a little bit, which I think is perfectly fine. And as we said in the article, our view is that, in my view, certainly is that if you want to have investment success over the next couple of quarters, one of the keys to doing that is to not get caught up in this inflation higher rate debate for several reasons. One, inflation is going to rise in the next couple of months in the United States, simply because the negative inflation numbers that took place in March through May of last year when COVID hit and stopped the U.S. economy in its tracks, those numbers fall out of the calculation, the year-over-year calculation. So in a mechanical sense, inflation rates are going to rise. And what you're seeing is that mentality being translated now into the fixed income markets. Maybe because of all the Fed activity, et cetera, the fixed income markets have actually been pretty late to this idea of kind of a reopening trade. Equities have been moving in this direction for some time, starting to accelerate that move into the reopening, and we'll talk about that in a bit. But the fixed income bond market, particularly Treasuries, have been kind of slow to pick up this point. And now, of course, it's done so when we've gone from 95 bips 2 months ago to 135. And I think we're on our way, as I mentioned in the article, to 1.75 to 2% on the 10-year towards the end of this year. And for all our concern and all the press about it, the history is pretty clear that this does not impede stock market prices from going higher. The history is actually quite clear. Whether you go back 100 years, for example, as the Lewithall group did with some work over the weekend. When rates are under 3% and rising, stocks do well. Or JP Morgan recently published some work showing that over the last 20 years, stocks and rising yields have been positively correlated. So stocks and rates going up at the same time. So to me, this idea that rates are going to go higher and they're going to stop the stock market in its tracks is I think, just off base, and is something we shouldn't really spend a lot of time on. What we should spend time on are the fact that the Biden administration is going to go big and go fast. We're going to see that this week with the first vote on the Biden rescue plan, probably going to be somewhat close to $1.5 trillion to $1.75 trillion. And then Biden is going to follow that up next month with the introduction of his climate and infrastructure plan, which is probably going to be another $1.5 to $2 trillion. And so going big and going fast is what the Biden administration learned from working in the Obama administration, where they didn't go big, they went small and they went slow. And the result was a subpar economic recovery that led to the political anxieties we've seen expressed, sadly, in the United States over the last couple of months. So that's one thing investors need to be paying more attention to. And then secondly is the idea that the U.S. administration, the political environment in the U.S. is moving away from government is bad, we should shrink government, to a mentality of government is good, and we should accelerate the force of government to deal with the very big issues like COVID, like climate, like inequality. So when you think about the news, let's say, about Texas and the weather problems there and the challenges many people face, obviously we hope people are doing better, and the situation in Texas is becoming more in hand and more stable. But you can't really think about a better advertisement for a climate and infrastructure plan than the complete collapse of the Texas utility and electricity grid because of a snowstorm. It follows perfectly with the collapse of the U.S. healthcare system during COVID. And what these things do is they raise the recognition amongst the citizens and the populace of the need for government to step in and deal with these big issues. And so I think that's the regime change that we have going on politically in the United States. And I think it's very, very important. And it does suggest that we are in the beginnings of a bear market for bonds, which will then have dramatic allocation implications, as we've talked about. And I'll stop here with the reminder that we see being played out in the stock market on a day-to-day basis, that vaccinations and rising interest rates are kryptonite for big technology stocks. I wrote that months ago, 4 or 5 months ago, and it's become very, very clear, even on a day like today, that that is definitely the case. And that means that the allocation shifts away from U.S. equity leadership to non-U.S., away from growth and tech to value and financials and energy, et cetera, away from big cap to small cap. All that is playing out and has much more to go, in my opinion.
No, that's fantastic. That's kind of a great start. And today is the perfect day, for us to be talking about that, because if you look at what happened in the market, a lot of that, is the stuff we've been talking about for quite a while. That you have been talking about for quite a while. And on your Musings Friday, you talk about jets, you talk about XLE. So looking what happened to energy, a pity that Petrobras is not profiting from this, and also. The market started a little nervous today, with U.S. Treasury at if I'm not wrong, 138, the 10 years. And we think, of course, it has a lot more to go. So and we had Tesla, breaking the 50-day moving average. So there's a lot of things that go into what you say. So I'd like to turn over to you so you can talk about which one of your calls are moving faster, which ones are moving slower, and what do we do here? So we just stay the course.
Okay, yeah, that's great, Roberto, and thank you for mentioning that. I do think it's worth reminding the audience that I did highlight specifically JETS as a reopening trade and XLE as an opportunity to make money in old and new energy. And I talked about how XLE had handled the potentially negative news of Saudi Arabia ending their voluntary cuts, as well as the U.S.-Iran conversations possibly restarting, both of which theoretically could be seen as being negative for oil prices. And I mentioned that oil handled it like a champ last week. And what do champs do? They come back and do knockout blows. And so what do we have today? We have XLE up 4.5%. We have JETS up over 5%. And that's not the first time I've mentioned JETS in the musings. I've done it multiple times. And have highlighted that as one of the more attractive parts of the reopening trade, because much of that part of the trade has not really materialized, right? The true reopening, the cruise lines, the airlines, the restaurants, the commercial real estate, those types of areas have not really participated in some of the big moves that we've seen in the last couple of months in some of the thematic stuff like crypto and clean energy, electric vehicles and batteries, etc. So now it's a very interesting dynamic that's going on in the market that I really want to get to in terms of specifics within thematics. But what I think I'd like to do first, if I can, Roberto, is maybe walk folks through very quickly my global risk nexus indicators on health, economics, policy, and politics. And then we can wrap up by talking about the markets. Does that sound like a good approach?
Excellent. Yeah.
Because I do think it all starts with health, and the news coming out of on the health side is really quite positive. And so I want to say that over the weekend I gave some thought to this, and I've added a new component to my COVID speed lexicon. So remember, I've been very focused on COVID speed since last spring. The speed of the spread, the speed of the policy response, unprecedented, the speed of the market reaction to that policy response, also unprecedented and left most people behind, the speed of science, which led us to a vaccine in 1/10 of the time it normally takes, and then the speed of delivery, which has clearly been the less speedy of any of them, but is now getting better and better and moving faster and faster. And so I'm adding a new addition, which is speed of the fall. And here I mean the fall in cases, and they are absolutely dramatic. Cases and hospitalizations down by 40, 50, 60, and 70% in the course of the last month or so in the UK and in the United States. Folks are now talking about the US being able to almost fully reopen by Memorial Day if the current declines continue in the weeks ahead. And the real issue over this week, last week, the next couple weeks is, can the speed of vaccinations offset the linkage between mobility and rising case counts? Because that's what we've seen, right? In order to shrink the case counts, we've had to squash mobility. So now with vaccinations and the fact that the more contagious variant, the B.1.1.7 version of the virus, does not seem to be having a dramatic effect on case counts in the United States. So maybe we are getting to the point where the vaccinations and the immunity of folks who have already had COVID can break that link between increased mobility and increased cases, in which case we are kind of off to the races. And if folks like Pantheon Economics, who made the case that the U.S. could be almost fully reopened by Memorial Day, which is the start of the U.S. summer, late May, that would be very, very positive for risk assets and for risk appetite. So that's the health component. I'm sorry, Roberto, you want to say something?
No, I was just going to add that we have. Of course, Israel is off the charts, but we also have very encouraging news from the UK. If I'm not wrong, Boris Johnson was going to speak tonight about his reopening plans, and UK has done almost as well as the US in terms of percentage of population that was vaccinated, and it's talking also about reopening. And it looks like after the missteps with the procurement, it looks like Europe has gotten its act together. I see the new Draghi government in Italy. They are setting up the infrastructure for massive vaccination, which is gyms and also schools that are going to vaccinate people massively. So Europe knows that they are far behind. They at least they admitted the mistakes. So I was just adding to what you said. So it's going to be the US, the UK, and then Europe catching up.
Yes, and on that point about Israel, the news on the Pfizer vaccines being 90% effective in suppressing cases is very, very positive, and reinforces that point. And then the other point, I'd pick up on what you said, that you're exactly right. I think we're moving from concerns about having enough supply to concerns about finding ways to inoculate more and more people, the demand side. And that's where we want to have the challenge, right? Increasingly, we know we're going to have the vaccine supplies, both in the US and in Europe. And that means we now focus on, okay, how do we get more people into the lineup for getting their vaccination? So I think on the health side, very positive news, which helps underpin kind of the appreciation in risk assets that we've seen, year to date, roughly 5% in ACWI. The other thing that has also been very supportive is on the economic side, where the data pretty much around the world has been better than expected. Certainly production data has been very robust, but even consumption, both in the United States, where January retail sales were up 5% year over year. So this is not comparing to the depths of COVID lockdown in March and April. We're talking about January 20 versus January 21, US retail sales up 5%, showing you that when folks do get the stimulus checks, they tend to spend that money. So this is really starting to impact the policymaking community, who are starting to actually see real live examples about stuff that we've only talked about theoretically, namely give people money on a regular basis. What are they going to do with it? So they spend it. The other consumption point is in China, where the lunar holiday sales were up 30% year on year. So that is comparing a COVID environment, but 30% year on year, retail sales up in China. So to me, both the US and China, the two big consumers, are consuming. Production is booming. And so I think what we're going to see next is the gap between production with global manufacturing PMIs in the high 50s and services, global service PMIs in the high 40s. I think we're going to see that come closer together, mainly by the service PMIs picking up as we get more people inoculated, more reopenings, whether it's the UK. In New York City, we're now up to 35% capacity for indoor dining. 2 weeks ago, there was no indoor dining. So gradually, making moves higher. And I think that's another, when people talk about bubbles and how there's no rationale for why prices are doing what they're doing, Think about where we are with the better news in science and COVID and health. Think about where we are with better news in the global economy, and that helps one understand that there are some important rationales underpinning investor enthusiasm for certain risk assets. And so before we go to markets, I would just want to mention a little bit about politics and then policy. And in politics, I'd simply say that the Biden administration, continues to make the case for moving big and moving fast. I touched on it a few minutes ago, but the first vote on the rescue plan will be this week. And the expectation is that that will be passed by reconciliation. In other words, not trying to water it down, dilute it, delay it to get Republican support. It will be passed by reconciliation on a straight party vote. And then without missing a beat, there were news reports this weekend suggesting that the Biden climate plan, which will be, again, a $1 trillion plus climate plan, will be introduced in March. And as I noted, you can't really ask for a better advertisement if you were, looking for such, for a climate plan than the last year in the United States between the wildfires in California, the Texas whiteout last week in Texas. It's becoming very, very clear that there is a great need to improve the efficiency, the security, the stability of the U.S. infrastructure, which even before all these disasters and storms had received like a D in terms of a grade for its positioning by U.S. engineering advisory groups. So I think there's going to be a continued push by the Biden administration on the rescue plan, on the climate plan. There is dramatic amounts of money that is sitting in savings in the United States, roughly $2 trillion that will free up excess savings, roughly 9% of GDP. And I think you're going to see that. We referenced that actually in our Brazil Journal piece, that we're going to see that money come into the economy in the next couple of quarters, next couple of years. And so on the policy and politics front, I feel that the news there likewise is quite good. And so that obviously leaves us with markets. And I think I mentioned the energy and how oil acted like a champ, and then it comes out today and goes up 5%. And what's really interesting to me, I'll make one point and then maybe pause, see if you have any thoughts or questions, Roberto. Really, really interesting to me is this unique opportunity, as I see it, to make money in thematics in both things like old energy, oil, and new energy, electric vehicles and batteries. I think the same is true in financials. Make money in traditional banks, XLF, EUFN, in new financials, fintech, ARK fintech, for example, ARKF, and in materials, the same idea that you can make money in PIC and XLB, in part being driven by the demand in the clean energy space. So look at PIC and look at PIC today, up 2%, XLE up 4%, and the clean energy stuff all down 5 and 6%. So if you have a balance, and I've talked a lot about thematics, and it's the main focus of my work at the moment. But what this new thought is, this idea of thinking about thematics with a split between the old style of the theme, XLF, XLE, the new style of the theme, clean energy, fintech, etc. And you play those off, and a day like today is perfect because the clean energy, ICON, lit, BLNK, they're all down 5 or 6%. So if that's all you have in your portfolio, you're going to have a horrible day today. But if you balance that out with positions in XLE, in XLF, in PIC, those are all up 1 to 3 to 4 to 5%. And I think that's really fascinating to think about, portfolio structure, allocation, ETF, using ETFs, and balancing between the old and the new part of the theme.
No, that's fantastic. And given that you're talking about, you talked about financials. There's the new and there's the old, it's always a good opportunity, for you to mention your call on European financials. And I was talking to a fund manager here in Italy, over the weekend, and he always looks at financing conditions, and that's kind of his background. He looks. The way he looks at his investments is, okay, are financial conditions improving or worsening for that sector? And then he talked about financial conditions in Italy with the Draghi government. And then, he was talking about Unicredit, which is trading at 35% of tangible book. So, that's there was a very unpopular call that we've had for a while. And I guess, it's with yields moving up and then the improving, financial conditions in Europe, I think it's probably going to do very well.
Yeah, well, it's great that you mentioned that because I did. I think I also referenced it in the musings that I'm finally making money in EUFN. Last week, finally, we got above my purchase price, which, to be honest, is a position I've held for several years. So, part of folks who know me and understand and been following my work know that I do that sometimes. I do have long-standing positions, and I'll size them in a way that allows me to stay with them if I believe in the story. And the European financials is the prime example. And it's gotten to the point, like when I'm on Bloomberg TV with one of the anchors there, John Farrow, he constantly calls me out on it, because he knows he's heard me say it so many times, and it hasn't really worked. I mean, it did work. It was EUFN is now at almost $19. I called it a screaming buy on his show late summer, early fall at $13. So we've gone from $13 to $18 in EUFN, and I think, as your friend suggested, we're going considerably higher. Considerably higher. If you're talking about some of the biggest banks in the world in an economy in Europe, the European EU-wide economy is a $18 trillion economy. You're talking about the banks in that region trading at less than half of tangible book at a time when the economy is about to reopen, that the bankruptcies and non-performing loans have been much less bad than expected, that the interest rate, the onerous interest rate structure under which the European banks have had to work for several years is finally starting to ease. Germany, for example, auctioned a 30-year bond off finally with a positive yield last week. It's the first positive yield auction in German bonds in about a year. And I think there's a reasonable chance that the 10-year bond, which is kind of seen as the EU safe asset, because there is not yet a European-wide safe asset, I think that's going to change as a result of the Green Deal in Europe, which we could get into. But my point is that the 10-year bond was trading minus 65 basis points a couple of weeks ago. It's now minus 35. JP Morgan just cut their estimate for the year end to minus 20 bips. I think it's going to be minus 20, maybe 10. Maybe we'll see a positive yield in the 10-year German bond a year by the end of this year. In which case, again, European banks will be trading much, much higher. And so I do think there are those opportunities. And again, people hate Europe, but Europe, like the United States, we talked about much better than expected economic data. there's also much, much better expected earnings data. The beats, according to JP Morgan, who does a really nice regular weekly update on earnings by region, the European beats were the best in the last decade, this reporting quarter. In the United States, JP Morgan said the other day that this is the third best quarter for earnings beats in the US in the last decade.
Yeah.
And yet you hear nothing about it in the financial press. There's nothing. It's all about bubble, 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 as opposed to earnings doing way better than expected, decade better than expected, outperformance, the best in a decade. You're not seeing that across Wall Street Journal or CNBC or Bloomberg, but that's the reality. And so I think that's the case in Europe as well. I continue to be constructive on Europe, on Japan. We are making the turn away from U.S. leadership. Given that tech is a third of the U.S. Index, and given that rates are going higher and vaccinations are going higher and faster, you can already see the work from home. You know, if you look at like Zoom or something, Roberto, right? The work from home stocks, they peaked versus the S&P last fall in October. And yet, you know, people still talk about it as if it's going to be the future. No, what's going to be the future is offices are going to refill. Cities are going to recover. Interest rates are going higher. Stock prices are going higher. And that's really the future. It's not more work from home. It's not more bubble, bear market. We're in a market where I think we have days like today where clean energy sells off 5 or 6%. Bitcoin goes down 8 or 10%. But it's what I called a couple weeks ago in one of my musings, a pothole market. In other words, you're driving down the road, you're going 55 miles an hour, you hit a pothole, and the whole car shakes, and you're like, oh my God, what was that? And then a mile, 2 miles down the road, 5 minutes later, you don't even remember the pothole because the car's fine and you're continuing to drive down the road. So to me, as we get closer to the reopening, closer to, you know, manifesting the economic activity that people are talking about, I think one wants to take advantage of these sell-offs and do that kind of repositioning within the themes that I mentioned a few minutes ago. So, you know, 3 weeks ago, XLE was underbought, right? And ICLN was overbought. Now ICLN, the clean energy ETF, is off 10 or 12% from its high, and it's approaching oversold conditions. XLE is now overbought. On a day like today, you're now with an RSI, around the 14-day RSI is approaching 70, over 70. So, you know, the market is giving you opportunities to position around these different issues. And for me, it's the reallocation, overweight equities, overweight commodities, underweight bonds materially. Take the bond underweight, reallocate it to commodities and to thematics. And I think that's where your opportunity set is going to be.
You know, that's great. And, you know, it's all moving along nicely. And, you know, of course, people talk about bubbles, but, you know, very few of them remember that, you know, earnings have been, you know, as you said, you know, the positive surprises, you know, have been, you know, as good as they, you know, as good as they can. And so now, you know, to the main topic of our show, and also what we talked about in the article, which is you know, rate, but more specifically inflation. So how can we assure people that they should not worry and you know, forget the noise, look through it, that you know, despite, you know, headline inflation is going to be you know, an issue, they, you know, should not pay attention. So can you go over, you know, how you see things playing out over the next few months?
Sure. And I think it's important, exactly as you say, to kind of figure out where you're going to pay attention. Because as investors, we all have limited bandwidth, right? And there are many, many possible claims on our time and on our mentality and all on our ability to absorb information. And so to me, the real big issues are some of the regime changes that we've talked about, right? That you're at once in a 50-year global economic boom. The first bond bear market in US Treasuries in 40 years. The first significant sea change in US political dynamics in 40 years. And those are the things that investors need to understand and think about how they want to be positioned. Because very few of us will have invested during that time span, right? Who was investing the last time the global economy grew 6% in 1973? How many of the folks on this call were investing then? I would argue virtually no one.
I mean, they weren't born. They were not born.
Yes, exactly. I was born, but I was not investing.
Yeah.
And so, you need a process. I think the point I would want to make to investors and to clients and the folks here on the call is you need to have a process, because otherwise you can't, you have no experience. Even those of us like myself who have invested through a number of different bull and bear markets and different places at different times, you still really don't have experience with the global economy growing 6%, with a bear market and a sustained bear market in US Treasuries, with the US government shifting gears in a very dramatic fashion from the Trump administration shrinking government to the Biden administration leveraging cheap money to serve the people in things both on the COVID and climate side. Those are the focus areas, not whether interest rates are going to go up, because of course they're going to go up. Inflation, we would like to have inflation. Obviously, everyone's taken on more debt. There's a tremendous, any statistic you want to look at, debt is higher than it's been in many, many years, many decades, maybe more higher than at any point in modern times. So we want inflation, right? Inflation is good. I think that was one of the contributions you made to the article, the idea of financial repression and what that means. So we want to have some inflation. It's way better than deflation, way better than deflation, particularly in highly indebted situations. There are very little in the way of default risk, right? If you look at defaults, again, Moody's and others, Standard & Poor's, folks who pay a lot of attention to default risk, the default risk is very, very low because we're going into a global boom. And the governments have supported the companies over kind of bridging through the last year of subpar economic performance. And so to me, mechanically, we're going to have higher inflation. The Fed has told us that via asymmetric inflation targeting, or AIT, it wants to have inflation. It will allow inflation to run above the 2% target for a period of time. I think the question as we get down the road is going to be, well, what is that period of time going to be? Is it going to be a year? Is it going to be several years? Some of the Fed governors have talked about it's going to be most likely at least a year of above target inflation in the United States before the Fed acts. And it's the Fed that acts that tends to put a stop to bull markets and stocks. And I believe we are quite far away from that. I don't think the market is saying that the first hike by the Fed will be in 2024. People are moving it towards late 2023. I think late 2023 is perfectly viable, but we're in the first quarter of 2021. And so I don't really think we should be investing in the first quarter of 2021 on what the Fed might do 2.5 years from now. I just don't think that makes a lot of sense. So investors need to understand the background, the context, which I think our article did a pretty nice job of doing, laying out that context, and then not worrying about it and not focusing on it, and understanding that it does have big asset allocation and portfolio structuring implications, particularly around U.S. equities and U.S. big tech. If that's where you've been positioned and those have been the places to be for a decade, you should be taking profits in those areas and reallocating to non-US markets, to Europe, to Japan, to parts of the emerging markets, to small caps, to value, to cyclicals, to financials, materials, energy. And then, as I've tried to make the point, and I think it's very important for alpha generation, I think you need to look at thematics. The shift in COVID speed away from health to climate, right? We've seen the model. The model is global intellectual and financial capital focused on a single issue creates vaccines in 1/10 of the time it has taken historically. We're now taking the same model and we're applying it to climate, and we're going to have the same effect. And so people talk about a bubble in IPO activity and then SPAC activity. I think that's a mistake. I think what's happening is that the investment community is providing public market investors with an opportunity to get closer to the early adoption stage of the innovation curve via IPO activity and SPACs. And some of them won't be successful, of course not, but some of them will be. And so you'll be able to participate as a public market investor in some of this innovation, which is happening much, much faster because of this COVID speed and this model of intellectual capital and financial capital globally focused on a handful of issues. So to me, a bear market in US Treasuries means that many of the portfolio strategies that met with lots of success in the last decade and accumulated lots of AUM, namely risk parity and 60-40 portfolios and balanced funds, because you had both a bull market in stocks and bonds, a 10-year, from 2010 to 2020, the straight 60-40 US portfolio returned 10% per annum. 10%. And going forward, though, the question is really, what is it going to return going forward? And the estimates by people like KKR and GMO and others is 1% to 3%, which makes sense because the 40% is in a bear market. And the 60% is starting off at a fairly elevated valuation level. So how do you generate alpha? Where are you going to get, if you're a pension fund, your 7% target return? If the 60-40 is going to return 2%, and you're already pretty fully invested with your alternative stuff. You need to go to commodities, which most big pools of money haven't really been involved in. And I believe you need to focus on the thematic side of things, where I believe that thematic sleeve, somewhere between 15 to 20 to 25% perhaps of one's portfolio, grossed up, if you want, to 100% of a thematic portfolio, can be your alpha generator in climate, cyber, genomics, fintech, and crypto. And that's really where I think folks need to pay attention.
No, that's great. That's very interesting. And of course, we talk most, about the opportunities in energy. Both the clean and old energy, and also, to some extent, on the financials, the old and new financials. So, are there any vehicles, in these other thematics that you've been talking about? So, looking at, of course, crypto, we have Bitcoins and the currencies, but, looking at genomics, and also other areas.
Yeah, really, it's the ARC family that I think one can look to in particular. There's an ARC genomics, there's an ARC fintech, as well as just the broad ARC innovation. The way I think about it is really the innovation space. So you want to be in innovation and disruption. So we're not saying like avoid technology, not at all. We're saying big cap tech is basically a long duration growth asset that will suffer from vaccinations because it's gotten the boost from the work from home strategy of the last year and from rising interest rates, tarnishing that valuation of a long duration growth asset. So we want to be not in domination. I think of the FANGs as like dominations, right? They dominate their space. So, but we want to now move away from domination and move to innovation and disruption. So that would be like the broad ARK ETF, ARKK. Then you want to think about internet and e-commerce. And there, I love the vehicle EMQQ, which you know we've talked about before on the show. And it's a perfect example of what's wonderful about the ETF space is that in one instrument, you can get total exposure to all the top names throughout the emerging markets in internet and e-commerce. So Stone in Brazil, Mercado Libre in Argentina, Yandex in Russia, Tencent and Alibaba and others in China. Fantastic opportunity. And then you go to the climate, and there you have a whole range of opportunities from batteries in LIT, which is sold off fairly aggressively. Probably worth a look. I think it's down 10 to 15%. The electric vehicles, cars, KARS, an interesting vehicle, not to use the vehicle both ways, but an interesting instrument to participate in electric vehicles, again, global. So not just Tesla, not just NIO, but globally in electric vehicles. And then clean energy, ICLN, also is sold off here. So the clean energy stuff, which did get heated, is now many of the ETFs are off 10 to 15%. So they're now no longer overbought, they're approaching oversold. And as I said earlier, the old energy, XLE, et cetera, which was massively oversold, is now approaching overbought. So you can toggle between the two. If you're a trader, you can toggle between the two. And then genomics, ARK has an ARKG, very straightforward and easy to contemplate. And then fintech, crypto, ARK again, ARKF for fintech, also has a vehicle there that you can utilize. And I think there is a melding or emerging increasingly between fintech and crypto. As crypto gains more institutional adoption, and every week that goes by, there's a new institutional adoption. Most recently, last week, after the BlackRock news of several weeks ago, Bank of New York Mellon, one of the world's largest custodians, 2 weeks ago. Last week was the launching of a Bitcoin ETF in Canada, the first Bitcoin ETF in North America. All these things are pushing and reinforcing the fintech trend. And I think you're going to see the two of them kind of come together to push each of them into greater and faster adoption. And that's the way I'm thinking about those, is really thinking about them almost as one fintech crypto. But then, of course, you come to the sizing issue, and that really is becoming the challenge, right? Because if you had a Bitcoin position at the turn of the year of, say, 2%, well, now it's 4%. And if you had a fintech position of 2%, now it's 3.5%. So instead of 4, you're at 7.5 to 8 of your portfolio. And that obviously starts to generate some sizing concerns. And I think that's really, as I say, for me, a big chunk of my time is focusing on that thematic sleeve and positioning it and understanding kind of wrinkles like this idea of toggling between old and new energy, which frankly just came to me really over the last couple of days, but I think it's really a very interesting way to think about things. So you have a half a dozen at least kind of buckets in the thematics. And you can play with that, depending on how you want. One of the things I'm doing at TPW is for our model portfolio delivery services is working with people to construct these thematic portfolios. And how much of the true new thematic do you want to leaven it with some less volatile old thematic, and playing with it that way. And that is where, certainly if you look at performance, that is where the performance has come from over the last 6 months or so. And I think it will continue to come as we go forward, because I do believe we're at an accelerated pace of innovation. And that's where the market is trying to figure out where it can go, how fast it can go, how it should be priced. And therefore, that's really where the alpha opportunity is. And what I think is going to be a less generous beta market, particularly in the United States, less so in other countries like Europe and Japan, parts of EM, because those markets are not anywhere near as expensive as the US market.
Mm-hmm. No, great. And you talked, we talked before about the politics and the policy, and how Biden is going to go big, and the plans are going to be approved, and then in March you have the climate plan. I don't know if there's any kind of visibility, transparency on what they're going to be doing, and I know your expertise, in the way your methodology, is more long term. But maybe just before the announcement of the plan, would that be a good time to go back into the clean energy ETF? Is there any detail, any expectation of what's going to be announced on that plan? And if I recall, John Kerry said, a month or maybe 6 weeks ago, that they were going to move the market. What they were going to do on climate, would move the market. So, what can you expect? A lot of infrastructure.
Yeah, I think it's a good question, Roberto. I don't think there's been a lot of detail that's been released. I'm paying close attention to it, and really the thing that caught my eye was this idea that they do intend to present it by the end of March. By the end of next month was actually the quote in the paper, but I assume that means March. And I would say it's not too early to be thinking about it. And those using TPW model portfolio advisory services will have already benefited from position in PAVE, which is the leading infrastructure ETF, PAVE. And so that is already starting to move, as one would expect, in advance, because it's a broad ETF focused on infrastructure. And what's assumed that this plan will include a heavy dose of infrastructure spending that will be related to climate. I think it's going to be similar to what I see is happening in Europe with the Joint Recovery Fund spending and the Green Deal, where a big chunk of that recovery spend must be spent on climate-related expenditure. So I expect to see a similar kind of dynamic playing out in the U.S., though I would think the U.S., again, because of 40 years of Republican focus on shrinking government, the U.S. infrastructure system, roads, highways, tunnels, harbors, are pretty decrepit. And in New York here, we've been trying to get another tunnel under the Hudson to relieve the traffic going into New Jersey, in and out of New Jersey, and down the entire east coast of the United States. And the last administration put a stop to it and didn't advance the project. I think it's called Gateway. I think that, for example, would be something that most definitely, with Senator Schumer, a New York senator, now head of the Senate, Senate Majority Leader, that type of project will be approved. So those are some of the things I'm looking at. But I think also, I know we're getting close to our time. It's amazing. Time flies when we get together. But I think we wanted to talk a little bit about Brazil, if we have a minute or two.
Yeah, I mean, it's a Brazil-specific focus, but I would like you to share your comments that what we were talking about from your experience looking at emerging markets, and what can you infer from what you saw in the market behavior today. So your comment about selling off very fast on very thin volume, and then what you saw in terms of volumes, and we've seen events like this in the past. People tend to look for bottom fishing, but the way I see it is, I think there is going to be an increased risk perception in Brazil, and the main issue is the government has decided that the Brazilian consumers will not foot the full bill, from higher energy prices. So, and there's no way, to force that down on the Petrobras, throat, to shareholders' throat. So, I mean, where's the money going to come from? And it's a very, complicated balance, and it involves, very complex, governance questions. There's a board meeting tomorrow at Petrobras, so we're going to see how that plays out. You've seen that many times, in your experience in emerging markets. So maybe, sharing a bit of that, when from what you saw in the trading behavior today.
Yeah, great, Roberto. Because I did note, there are two positions I have. One is ILF, which is the Latin American top 40 names, which is about 60% Brazil, maybe 25% Mexico. And I did notice that it opened down 5%, and through 1 o'clock, when I looked last, it was only trading about 25% of its normal 90-day volume. And it was creeping back up. So in other words, the low of the day was the open of the day on very little volume. And so to me, that suggests that there's not a lot of appetite to sell, broadly speaking, Latin America. Now, Brazil, EWZ, had monster volume. So that's not the same thing at all. Obviously, directly exposed to Brazil, you're going to have more action. The other position is in EMLC, which is the local currency debt market, which Brazil is one of the top 10 positions. But perhaps more importantly, and what really got me interested in it, was China is now the single biggest position in EMLC at 10% or so, which is pretty amazing. And it's hard to get access to China local currency denominated debt, and because I believe the renminbi is going to appreciate, and I wanted to get exposure to that. So I actually several months ago switched out of EMB, which is the dollar, and into EMLC. And so I think the real at 550, unless the economy minister is fired or resigns, or unless there's a complete collapse in the discussion around extending the aid package and further building some of the fiscal adjustments that are underway in discussions now, I don't see the currency widening dramatically from here. And again, EMLC was down only 35 bips this morning. So suggesting again that the emerging market foreign exchange or local currency, it's not a place where people have really spent a lot of time, not a lot of heavy positioning there. So not a lot of downside. And if we are getting closer to more and more visible signs of Chinese consumption coming back, US infrastructure, things of this nature, then I would expect Brazil, broadly speaking, as a market to do reasonably well. And so I do think that at the margin, I would be more a buyer than a seller at these levels. And so that's kind of the way I would see it at this point. I have not done anything today, but I'm certainly not selling and don't plan to sell either of those positions anytime in the near future.
Yeah, I agree. I mean, I think people don't want to sell in general. That's and people are pretty much convinced about the rotation trade, and Brazil is part of that. Of course, today was a big scare. It's as if one expression that I used is there was a divorce between the Brazilian government and financial markets, and that's not the way it happens. Of course, when something like this happens, we have kind of the damage control operation, and then the government says that they're going to speed up the austerity measures in Congress, and you know how it works. And one thing you can count, as you said, is that the lowest is going to be the opening, because people had been panicking
all weekend, especially on a Monday. Yeah.
So it's like they've been getting in line to sell. Everybody wants to sell first, and I'm not saying it cannot get worse. Of course, it always can. Depending on what they do, but clearly the trade of the day, was to buy at the opening and sell at the close. My perspective is that looking at Petrobras and the fact that it's been down 30% in reais, from the close of Thursday till now, it probably has borne the full weight, of the full burden of the full cost of this, let's say, adjustment. So because it does increase, the fiscal problem in Brazil. There is some 70, 80 billion reais that are going to the government does not want to be paid by the consumer, and they can't force down on a Petrobras throat. So it to some extent it increases the fiscal burden. Let's see how the government comes up with this, but anyway, that would affect the whole risk perception on the market. So maybe buying Petrobras and being short the rest of the market in Brazil now makes some sense. Excluding the global cyclicals. So if you exclude Vale and Suzano, maybe basically the exporters.
Mm-hmm.
Big companies, pulp and paper, Vale, Gerdau, which has an operation in the U.S. I think that's what makes much sense in Brazil now. The banks are kind of in between. I think profitability is recovering, but I think GDP is going to surprise negatively in the first half.
That's interesting. I think one of the things to think about, in these types of markets is to look at technical analysis. And I noticed that Petrobras, at least in the dollars here, really broke through its 200-day considerably, and it's now about 10 or 12% below its 200-day moving average, whereas ILF and EMLC are both well above their 200-day moving average. And so, I'll leave the Petrobras specifics to you, but I think the fixed income in local currency, broadly speaking, of where Brazil is a part, is interesting. And then the other thing I would say, Roberto, and this is a big part of, I know what Ohm Research is doing, and certainly what I'm trying to do on the platform is, I think it suggests to Brazilian investors, domestic investors, both institutional and individual, that, the opportunity set is much bigger than it was 5 years ago, right? Where it was pretty much only Brazil, or even 3 years ago. We know that there's the opportunity, the ability to invest abroad is becoming more and more viable for institutions and individuals alike in Brazil. And that's really where I think the opportunity set is. And that's where hopefully TPW Advisory, Ohm Research, and others can add some value.
No, absolutely. And that's something we've been highlighting. Of course, institutions can do it easier. But now, there's all sorts of instruments that a lot of the brokers, XP Investments and lots of them, they are creating the structures in Brazil so they can profit from some of these themes. There's investment funds, there's ETFs. So it's great to have you on the platform and being able to do this every 15 days, because you talked about Jets, you talk about XCLE, and there'll be a lot more. Of course, it's a very fluid market, and people in an event like today, there were 1,000 posts saying exactly this. An event like today just highlights that okay, you should diversify, and for obvious reasons. I mean, I think if you work in Brazil and your compensation depends on Brazil, you should not correlate your wealth to that.
Yeah, exactly. Have a little diversification.
Yeah,
it's a good idea. But anyway, it's been great. I really enjoy these bi-weekly sessions. And thanks again for having me on and for having me on the OWN platform. And I guess we'll see each other in a couple of weeks.
Yeah, we'll see each other in a couple of weeks. Thanks again. Yeah, stay safe. Thanks our audience. We'll be back exactly 50 days. But anything if anything comes up, we'll be sending over to you. Thanks, Jay, and stay safe for the next couple of weeks. Thanks, everyone.
All right, Roberto, thanks very much. Take care now. Bye-bye.
Bye-bye.